My name is Michael Guyad, publisher of the Lead Lag Report. Joining me there is Doug Moglia of Game of Trades. Doug, introduce yourself to the audience. Who are you? What's your background? Did you get involved in markets? And how'd you hook up with the Game of Trades folks?
Great. Well, thanks a lot for having me. It's my first Twitter space, so I'm looking forward to it and appreciate that intro music. But yeah, just a quick background on myself. So I started in wealth management in New York City. So I worked for Bank of New York Mellon, where I was supporting some portfolio managers there, getting to know the business. And then I think, a couple of years there, I quickly realized I wanted to be kind of the guy behind ideas and research and not the one gathering new assets. So I pivoted to a job at Morgan Stanley where I was a cross-asset strategist, also in New York City. I was there for about 4 years. And so my main role there was I was writing a daily research note to about 25,000 people at Morgan Stanley that was covering the cross-asset tactical market developments. So really just a broad overview of cross-assets in the economy and what was really going on day to day. So now at Game of Trades, I'm the head of technical strategy here. So just a brief background on kind of what we do and who we cater to. So, we specialize in macro research primarily for individual investors and advisors. We do a number of things as far as, the products we offer. But I think our overarching theme is that we believe every investor should have access to some type of institutional level research and to be able to navigate markets without really having to understand, the financial jargon that's out there that makes it harder for people to know what's really going on. So we're really trying to take the noise and really the misinformation from the media and the internet that you see and distill that in a more easier way for people to understand markets. So doing that through a lot of different type of reports weekly and through actionable insights. So that's kind of the broad overview and brought us where I am today.
So speaking of misinformation, I am curious, given that it sounds like you follow probably not that dissimilar an analytical approach than I do from an intermarket perspective. Do you think that, and this is maybe a leading question, do you think that one of the big pieces of misinformation is that we're in a new bull market?
Yeah. I mean, that's a lot of ways to look at what indicators you look at where you are in a cycle or what, from an equity market standpoint. But I think for one, you have to look at Fed policy and what's led us there. So, like you said, intermarket relationships, economic indicators, policy, inflation dynamics are all kind of giving you a good overview of where we might be in the cycle and where we're potentially going. But, if you go back to 2022, the Fed engineered was one of the fastest tightening cycles we really ever seen, hiked the policy rate by 450 basis points in just 8 months, and we continue to move that higher this year to upper bounds down at 5.5. So, that initial significant shift in policy on the rate side affected equity valuations and interest rates, sensitive sectors like housing. That's pretty typical cycle behavior, especially in later cycle when the Fed has to fight against inflation. So as we know, the U.S. economy is influenced by both the availability of credit and the cost of that credit for both consumers and companies. But you really have to consider the magnitude and speed of the higher rates that we really saw. And that's something we haven't seen for decades, going back to World War II. But as far as real economy effects, and there's a lot of academics written about this, it takes about a year to year and a half before you really see higher rates or in the case of easing policy, lower rates to really impact economic activity. So, they started their hiking policy in March of last year. So really we're starting to get to the head of that around now. And so we're going to see a lot of more of the economic data be influenced by what we think was, really the worst tightening policy we've seen ever. And so that's number one. I think there's a lot of indicators you look at, and like you said, intermarket relationships as far as like, are we in a new bull market or early cycle environment? But the one of those, I think, I had a chart on this on my Twitter at one point, is you look at lending standards. So, if you look at lending standards relative to the ISM manufacturing, so that's kind of a good proxy for growth in the economy. And so usually you see in a late cycle environment almost every single time that banks are tightening their lending standards to avoid risky borrowers and, protect their balance sheets as the cycle as growth slows and the cycle comes to an end. And that's what's happening right now. At the same time, ISM manufacturing is continuing to move lower. So it's been in contraction 10 straight months. Very hard to say that's a new bull market or a new early cycle environment until you kind of see that kind of shift in manufacturing. I think the biggest pushback that we've gotten so far is around the services side of the economy and the consumer. So, you look at the ISM, like I said, it's been down in contraction or, what we consider less than 50 for 10 straight months. But the ISM services has been in expansion. So, that kind of caters to the fact that the consumer has been relatively strong because of that fiscal impulse we had after COVID, right? And so that's held up the consumer for some time. And so we think that is very interesting as far as where we are now, though, because excess savings by our estimation are now dwindling towards zero. We have oil prices that have been spiking. So that's going to affect, people at the pump and overall discretionary income. Student loan forgiveness is ending, credit card spending. If you look at, some of the data that's out there is from JP Morgan and Bank of America credit card data. That's been accelerating recently. And then we have delinquencies that are rising for credit cards and autos. And then, so really, the case for a weaker consumer is really starting to come now. And so you really have to have that in order to have a recession, because 70% of the US economy is consumption. So you really can't have, just the manufacturing be in a recession and then services held up. So, we think we're kind of at a breaking point there. And I'm happy to speak about, the intermarket relationships as well, but that's just kind of a starting point, from an economy standpoint.
Yeah, and that's one of those other disconnects that I myself keep trying to highlight, which is you hear that narrative that the consumer is strong, consumer spending is positive and all that. But, you look at the XRT retailer ETF equal weight of retailers, it's gone nowhere, right? A whole bunch of sideways, no new bull market there. That's also consistent with small caps, which should be more, you'd think consumer sensitive. So there are a lot of interesting big divergences now from an intermarket perspective, right? Divergences are often a big thing to put a spotlight on, right? Because they tend to get resolved. So the question then becomes, from the both bullish and bearish side, how do some of these divergences get resolved? Does it get resolved with, a big bang on the way down, large caps catching down to the relative weakness of everything else, or, the rotation, the catch-up trade? It sounds to me like you think it's more the former, not the latter, but let's riff on that for a bit.
Yeah, so I think you named some of those kind of intermarket relationships that are showing a real breakdown that's hard to say we're early cycle new bull market. Small caps is one of those, just to give people, kind of a little explanation for that. Small caps are much more less diversified than large caps. A lot of their revenue is derived from the US. So if you look at like Russell 2000, 80% of of the revenue is within the US. So, that's a good indicator for where, because it ebbs and flows with the US economic activity. So that's a great indicator to see, where potentially we are in the cycle. And like you said, small caps are at COVID relative low levels. So there's really no sign of kind of an uptick there. Another one I like to look at too is S&P equal weight relative to large cap. So that's kind of, the equal weight index is kind of thought of as like the broad market or the average stock, because you're not kind of taking into account those huge mega caps, right? And that's actually ratios continue to move lower too. That at November 2020 levels. So really no sign of recovery there. I think that, obviously this year, first half of this year, I think what you had last year is that everybody was bearish in summer and going into October where the bottom was. And so if you look at like hedge fund positioning, especially in the tech names, that was their net leverage was basically at all-time lows. So there was really a very, I wouldn't say easy, but there's an opportunity for on the long side because of just how bad sentiment and positioning was. And so that happened in tech because, earnings were still negative year over year, but they weren't as bad as expected. And so then you had the AI boom, obviously. And so now we think a lot of that is now priced, though, especially in the large caps, because, and this kind of tailors into what the Fed is doing too. Usually into Fed pauses, the market is going down 6 months before. But, our work is showing that, right now, into a Fed pause, the market is going up. And so it's kind of being front run that action into a Fed pause so far. So, that we're at the point now where we think a lot of these, tech names that are got significantly overbought are going to continue to move lower, and that's going to bring the broad market down eventually.
From the traders, the advisors, the wealth managers that are subscribed on the game of trade side, do you get pushback by people that are saying, oh, you're overly bearish or you're too negative? Because I often find that tends to be a contrarian signal in and of itself.
Yeah, definitely. I think that, especially on our reports. So we allow comments on our reports. So we're always something we're monitoring, the sentiment within our members and, being cognizant of that. Obviously, the first half of this year there's really no one that I don't think has predicted that type of movement in the NASDAQ, up 40%. So, that's something that we just kind of dealt with, as we move along. But I think we're kind of just adhering to more of our cycle dynamics or our cycle where we think the cycle is going. And that's helping us with positioning and kind of rationalizing that.
All right. So let's get into that, because there's always these sort of rules of thumb, right? When you're in this kind of regime, these asset classes tend to do better than others. Yeah, I think last year, a lot of people were disappointed by, TIPS, Treasury Inflation Protected Securities, as, one of the assets to play, because the duration side is what killed you as opposed to the inflation protection side. And I would argue that we're still in a weird environment where cycles are not exactly looking like they historically would. You can make multiple arguments as far as which cycle we're in, I think, just given from an intermarket perspective. So I think that makes positioning actually really challenging for the vast majority of asset allocators. So let's talk about from a advisor, financial advisor, wealth manager perspective. Given the cycle that we're in, right, where would you tilt?
Yeah, so it's difficult because I think the normal cycle behavior is that, when you're in late cycle, you want to be long the long duration bond and short equities and being more defensive stocks. So what's different now is that this cycle is inflation driven, right? And so that's what's kind of holding us up a little bit on the long duration side for, we still like TLT, but we think there could be a little bit more pain in the next couple months. But eventually we do think that it's going to turn around. But, inflation driven cycles, and especially now, I think, with the latest Fed meeting, we're pretty clear that the Fed is doing everything they can to bring this back towards their target, whether target is something that is warranted target or not. But, that's the type of environment where we think they're going to continue to be tight until they see a real sustainable move lower in inflation. And so that's one dynamic that's happening at the long end of the curve, actually. That's, keeping rates higher. Obviously, there's a lot more things going on there in the rates market. But from that, perspective, your long duration bets on bonds are going to take a little bit longer, I think, to work. But eventually we do think that does work. As far as, going, asset to asset, there's usually, and not always, again, we're seeing a spike in energy right now. That tends to happen sometimes in late cycle as well. But again, when you see a significant outperformance in energy stocks or oil, that's not always a great sign for what's going to happen with the cycle. And again, that's where it brings the consumer back into play. As far as the defensive stocks, so, that's one thing, that's another market relationship that we've been monitoring. And that's starting to be a little bit more positive now. We're looking at, so there's a low volatility S&P 500 ETF and a high beta S&P 500 ETF. That ratio has continued to move higher and it's breaking out now. The copper to gold ratio is something that peaked in 2021. That's continued to move lower too. So that's kind of those two, I would say, is also, kind of alluding to the fact that we still are in late cycle. So that's one thing to really to keep in mind, and what type of cycle we're in, what was driven the cycle. And this cycle is much more driven by inflation dynamics than anything else.
I feel that we have to hit on the dollar as it relates to the Fed. And I shared at the top of the nest from the Game of Trades, it handled the 11th consecutive green weekly candles. Now, I myself, said about 2 months ago, I think, the dollar's going to have the greatest comeback since Lazarus. I said the dollar and treasuries. Obviously, I was wrong on treasuries, right on the dollar. But the dollar move to me is really interesting here because you are now, at least if you look at like the UUP ETF, you're nearing the peak. You're getting close, not that far away from the peaks of last year when there was real concern around how that could cause a sovereign crisis outside the US. Let's talk about sovereign debt risk here, because I think that's still very much, on the table and it's just not being talked about that much.
Yeah. So, comment on the dollar. So we do have a model for that. And, precious metals is something, but he's also been touting that it's a good recessionary hedge as well. There's a strong negative correlation with real rates and the dollar on precious metals. And so that's something that we've been watching too. But as far as the dollar, we do think it could have, about 3% more upside, which in FX markets is pretty significant, just looking at a combination of rate differentials. But as far as, the sovereigns, I think the US is obviously a little bit different because, a lot of the yield movement has come from this treasury issuance that the market and QT on top of that really having a tough time absorbing that new supply on the market. And that's pushing yields higher. At the same time, as real yields and go higher, then that's also pushing capital into the dollar. And so that's something that we have to continue to watch. We think, it's probably closer to the end of that. If you look at something like the term premium, that's something that reflects, this type of treasury issuance. In the past decade, the term premium has been negative. And that's starting now to turn positive. So, as that turns more positive, we think that, yields probably could peak, its term premium is 50 to 100 basis points. We're at 0% right now. That's probably closer to where yields peak. So at the same time, that's where we probably would see the dollar peak as well.
Yeah, I think it's important to stress that. It's like I put out a post a little bit earlier saying, yesterday was both simultaneously the top and bottom in yields. And I was really referencing the idea that you can have a top in government yields, treasuries. I hear you, maybe it continues, but I think more likely to be a top, and then everything else would probably maybe start to move higher, right? Because corporate credit risk has not increased in a meaningful way. I am curious to hear your take on credit spreads. It looks like they might be starting to finally widen, which I think is long overdue. But where are we in terms of that side of the bond market?
Yeah, I think so from that perspective, you really are not going to see spreads widen too significantly until you see significant deterioration in the labor market. And, we can talk about that, but that hasn't really happened too much. There's signs of cracks, but, looking at something like jobless claims, last week it was 200,000. So, some people are questioning the, availability of data there and the fact that there's new revision every week, right? But, they've remained very low. And so the other part of the labor market that we've been watching is, hours worked has continued to fall, but layoffs are not accelerating. Like I said, the claims are very low. So I think that's kind of more of a sign of the labor hoarding that we're seeing. A lot of times companies are not going to react to headcount until they see their stock prices move lower, right? So that's something that we're watching. I would say that the payroll data is probably a little bit more concerning. The 3-month average of the NFP has continued to move lower this year. It started around 400,000 beginning of the year, and now it's 150,000. So that trend is a little bit worrying, but we're monitoring definitely from a high frequency data perspective, given claims are weekly. That's something that we're continuing to looking at, because when you see claims start to really inflect higher, that's when you see credit spreads blow out and equities really react. So, that's what we're watching right now.
Has it surprised to you as somebody who tracks this stuff and has put out research for a while that it's taken this long to see some signs of cracking in the labor market? Again, to go back to that point, that fastest rate hike cycle in history. So who the hell knows how it plays out? But there's the argument that the economy is resilient and the labor market's resilient. But then again, we see all these revisions, right, that seemingly just come previously.
I think it kind of speaks to the lag effect, right? This stuff takes time, and we're kind of in a new environment, really in the world, where everyone wants everything to happen immediately. I saw a chart the other day, was looking at the average hold period of a stock over the past century. The 1960s and 70s, which was like 8 years. Now it's 6 months. So people have very kind of attention span is quite low, and they want it to happen immediately. But that's not
on FinTwit, by the way. It's like 3 days for whatever it's worth. I'm with you.
Yeah. So that's a little bit how I feel that people are giving up a little bit on this too early, and cycles take time to play out. And this one is probably taking a little bit longer because of the impulse we had from the fiscal side that you can't compare it to prior cycles because we haven't had something like that helicopter money. So really, that's what I think is probably driving the cycle to be a little bit longer than usual.
From the cycle work that you do, how do average VIX levels tend to look when you're in cycles that may somewhat parallel what we're in now? It seems like last several days the VIX has been spiking a little bit. Right? Yep. I think you're kind of at one of those junctures where if it's going to move big, it's probably now, which is why I'm sounding the alarm around the kind of imminent risks. Right? When I said the most important week of the year, I'm really referencing that, right? Because you have a window for a super spike, I think. But when you look at average VIX levels at this point in the cycle, do they tend to be higher than what we've seen this year or lower? How's the VIX interplay?
It's hard to say because the volatility environment has significantly changed really just the past 2 years. So, 50% of the option market is now 0 days to expiration. So, that tells you a lot. The VIX is using options in 30 days on average. So, number one, it's hard to compare, where we've seen the VIX in, the 90s versus now. But, one thing I would point out, 2 weeks ago, the VIX was at the lowest since, before the COVID crash, right? It was at a almost 4-year low. And so, a lot of that implied volatility this year makes hedging a lot more attractive because, implied volatility for both puts and calls has come down markedly this year. That had a lot to do with the realized volatility. So we got to single digits in realized volatility in equities. And so that's really low. So, the low VIX gave a lot of people opportunity who hopefully took it, and if they didn't, but to hedge, with that of the money puts, or even if they wanted to hedge a melt up too, calls. But as far as average levels, I couldn't speak to exactly, where we could potentially see that. But again, the VIX definitely has a lot more upside if we're going to see, significant downside for equities.
Since you mentioned the zero DTE side, there are some that would argue that's changed some of these market movement dynamics, at least, certainly intraday. I'm a little skeptical because that just maybe sounds a little bit like narrative following price and trying to find something to explain it away. But do you think that kind of manic zero DTE volume trading is really impacting things structurally in a big way, or is it largely just kind of overblown?
Yeah, I don't know if it's like a structural impact. I mean, I think day to day, it's definitely going to increase volatility at certain points. But as far as like the overarching dynamic of the market, I don't know if it's going to impact on a long-term basis, but it's definitely something that you have to keep an eye on when you're at like, option expiration and things like this that are going to cause a lot of gamma to roll off and that type of thing. Like that's where you kind of see a lot of these huge volatility movements. So you have to just be aware of where you're at, but I don't think it's going to be a huge impact as far as like, changing the dynamics of trading.
I just pulled up as we're chatting. I look on stockcharts.com and I look at the percentage of stocks in NASDAQ trading above their respective 200-day moving average. And right now, as of yesterday, so is it by end of day, only 27% in the NASDAQ, 27% of the stocks are trading above their respective 200-day moving averages. So the vast majority of things, if you view that as, a marker for an uptrend or a downtrend, the vast majority of stocks are in a downtrend, not in an uptrend. Now, the challenge with breadth is that it just, as I keep saying, right, oversold is typically, where you have a bounce, but it's typically also where you crash, which is why trading oversold levels can be so tricky, right? Market crash for oversold levels. At what point does the breadth, from your vantage point, get to be, from a contrarian perspective, actually the best time to allocate? It doesn't sound like it's right now, that there could be still more pain to come, but what would be a juncture where you say, okay, this is too bombed out at this point?
Yeah, I mean, it's a great point. So I think, one thing you do look at in like a kind of bull market period, 2020, second half, 2021, they're using percentage of members above 50-day or 200-day. I'm looking at 50-day, but you usually see that above, around 70%, and it tends to hover around there when you're in a bull market. So if you look at a chart of that, you'll see it's pretty, I wouldn't say steady. It's still a little jumpy just given, the volatility of markets, but it definitely doesn't really have these huge crashes, below 30%. And so we did see a recovery. Obviously, the beginning of this year was very concentrated, right? Tech and these type of growth themes are driving the entire market while a number of sectors were negative in the first half of this year. So eventually we did see a little jump in small caps and in the other sectors as well. And that kind of expanded breadth, but it did not really sustain itself up there. We've significantly kind of fell back, like you said, for, percentage of members above 50, we're now at 21%. So as far as a significant washout, like this is a somewhat washed out right here. We could maybe see a bounce here. 20% is pretty bad, but if you ever get below 5%, it's almost like a blind buy. That's kind of how the quantitative work that I've done previously, that below 5% is just basically like you don't even just kind of put some money to work somewhere because that's just like significantly oversold. So that's kind of the level.
Yeah. And we hit that actually around the initial low last year, right? So around the kind of mid-June, level, it got to 9% on that metric, and every other major low, including the COVID crash, 2019, late 2018 move, Christmas Eve massacre, all that stuff. You had that some real deterioration. But speaking about divergences, we never on that, and I'll share it in a second, we never hit the high that was set in February of this year. So while the NASDAQ kept on rising, it's more than just the idea of Magnificent Seven leading it. It kept on getting gradually more and more narrow, right? Yep. And that is one of those classic divergences that an intermarket technician would focus on.
Yeah, classic bearish divergence. So, it's something we can draw on breadth too. Yeah, that's something that we definitely look at. So definitely have to keep that in mind.
So, from a sector positioning standpoint, there's been a lot of, I think, maybe reallocation or excitement back into energy. You alluded to oil a little bit earlier. Last year was weird in that you almost, I had Walter Deemer on, kind of these well-known technicians a while back. And he made this point that, you don't really see in a bear market any sectors positive. And yet energy was positive, right, in last year's market. If oil were to continue moving the way that it has, which is not my own base case, I actually think it's probably vulnerable to a decline now. But if oil were to continue, do you suspect that the energy sector would have the same kind of outsized outperformance like it did last year, or was that more of a one-off?
I mean, it's a good question. I think obviously the one-off last year was due to the Ukraine war, right? So that's part of the story there. But the one thing I would say about energy is that it doesn't seem like a lot of managers are getting too excited about it. Definitely on this move up in oil, positioning is still pretty bearish there. So, there's potential that if we do see a continued spike in energy or oil prices, that maybe, we do see significant move higher in energy. But, I don't know I don't think it's going to be as kind of, as good as last year, because I think, the reason that oil prices are moving higher is much more on the supply side. It's a very physically tight market. Obviously, Saudi Arabia and Russia, supply cuts are continuing, but the demand side is not something that we think is going to be good going forward. So that's where I think the equities come into play. That if demand's not great, you're not going to get great returns on the energy equities.
So it sounds to me like, okay, if you're going to be forced to be equities, tilt more defensive, lower beta, dividend plays. So let's talk about the defensive sector side for a bit. Yep. I always like to emphasize utilities because I've done research that shows that utilities are not only a leading indicator of stock market volatility. By the way, they did get this right, meaning that surge happened before this VIX spike. That's consistent with all the research I've looked at on utilities myself. Yep. But, there's more than just utilities. There's also consumer staples and healthcare. Those are showing some signs of strength, but of those three defensive areas, where would you say there's the most relative outperformance?
Yeah, I mean, so I think healthcare has been one of the, both of those three are the main ones, obviously, for as far as lower beta, more stable earnings and defensive. I think healthcare could be interesting because of the fact it's a little less rate sensitive. You look at, utilities and consumer staples there, in addition to being defensive, they are also pretty much bond proxies. So that's where you could get a little trouble if you see rates continue to move higher, but, equities are also going down. But again, eventually we do think there's going to be a flipping there where, the correlation between yields and equities become negative, but we're not potentially there yet. But I do think that, in the near term, healthcare probably is better defensive. And then eventually it'll be utilities and staples that once we see real rates and rates start to come down in the real recession fear moments, that's when you want to kind of go on those two.
Yeah. And health is interesting because, it's like if you're going to have a breakdown in tech, just because it was the market leader, from a growth style perspective, healthcare is one of the big growth sectors, right? In most of these growth industries. So you could see conceivably a relative trade of out of tech into healthcare.
Absolutely. And again, there's still a lot to go down as far as, the positioning that was covered from last year in tech. We were near record lows and then that's just ramped up significantly this year. So that rotation, that type of rotation definitely has legs, I think.
So reset the room for the remaining 20 some odd minutes here. Everybody, please make sure you follow Doug Moglia here on X, as well as the Game of Trades handle. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be a podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. Okay, so we talked a little bit about positioning. Seems like everyone forgot that a recession is still out there just because it got delayed. And again, narrative follows price with everyone focused on the NASDAQ. I know it's hard to really know, and this is always the big question, but if we assume a recession is coming next year in an election year, what kind of depth are we talking? Right? Because there's soft landing, there's, soft recession, and then there's, something that can metastasize into like the big D word.
Yeah, that's a good question. I think the fact that we had such significant, if you look at like something like retail sales, 20% above trend after this huge fiscal impulse of this recession, as we have the housing market is still relatively strong because of the low inventory. So the wealth effect on consumers has been relatively positive with stocks up this year and housing prices not crashing. But, there is a potential where we see housing and stocks actually start to crash together and all of that kind of, pent up demand or, wealth that was accumulated after COVID and recently goes away really quickly. And that's when I think you'll see significant earnings declines. It also depends on the trajectory of inflation too. If inflation just goes down significantly more than expected, that's where you're going to see a lot of these companies lose all their margins and really their pricing power that they had before. And so that's where you see a significant recession that people may not be looking at. That doesn't mean we're going to have a Great Depression. Definitely not saying that, but I think it could be worse than people expect.
Yeah, I don't disagree. Especially, I mean, the only reason I mentioned the depression idea is, the real extremists, not my base case either, but I can see the argument would be, the government spending now is getting to a point where it seems like the bond market's puking on it, right? So if we're at the point where monetary theory is no longer the accepted, way of the way the world works, right? Then conceivably something ugly could be coming because we haven't seen the bond market vigilantes going on U.S. treasuries like we've seen, more recently, I'd argue.
And it's also, just to put in real quick, I think it's interesting how the Fed and the fiscal side is going to come together next time we have a real drawdown, right? Because I highly doubt we're going to get expansionary fiscal and monetary together. They're not going to want to deal with that inflation problem again. So we could get tight fiscal and expansionary monetary. I can't imagine they wouldn't restart QE, but who knows? But so that's something that also, could make the recession or a little bit worse than expected. We don't get that fiscal side this time.
How does all of this impact the precious metal side? So I myself have made the argument like I think gold probably is going to have a breakout. And I say that because if I am, if my whole thesis is that we never entered a new bull market, it's always been a bear market rally, right? And if it's still a bear market and if institutional investors start believing that, then what are they going to do? They're going to probably want to allocate to non-correlated assets. There are not that many. Gold is one of them. So that creates a little bit of marginal demand and maybe starts the momentum cycle in gold prices. But talk about kind of your outlook on precious metals at this point in the cycle, and should there be more focus than just gold when people talk about the side of the investment side?
Yeah, silver is definitely in there. So I think we like gold and silver going into recession and coming out of it as too. I think very near term, we're a little bit worried or concerned because of the fact that we think DXY might have a little bit more upside. And so, that could, see precious metals, given their significant negative correlation, move lower. But I think what's interesting is, if you told me at the beginning of the year that real rates would be up 70 basis points this year, I would tell you that, I would probably buy every put I could on the GLD, and GLD is up 4.5%, right? So that's a little bit of a message that, gold is still above 1900 and we have real rates above 2%. That's pretty interesting from a cycle dynamic telling you that it's a little bit more defensive here. And so once we get that, real rates and potentially the dollar moving lower into recession, are we going to see a significant move higher in precious metals? I would say as far as like which one to favor, silver is obviously a little bit more high beta volatile. It's more levered to dollar moves. Silver as a commodity is more industrial based. So, that's why it's a little bit more volatile. So in precious metal bull markets, you want to be a little bit overweight silver relative to gold. But, we like both right now.
Yeah. I mean, it just seems like there's some real relative strength potential. Do you guys do any work on Bitcoin at all or cryptocurrencies, or is it more on the traditional asset class side?
More traditional. We have some technical reports that look at Bitcoin, but we don't have any significant cycle analysis or anything like that. So it's more just on the price action.
Okay. Yeah. I was just curious. I mean, I myself have argued that Bitcoin diverges. You had a moment in that regional bank crisis in March where Bitcoin acted like a risk-off trade, but it only lasted for like a couple of weeks, right? Now that does, I think, bring an interesting point here. Most crises are refinancing crises. That's something that Michael Howell of Cross Border Capital has referenced many times. So if you are going to have higher for longer, at some point, a lot of these loans are going to be due. They're going to roll over into those higher rates. Presumably there's going to be some default risk, right? Which means there's counterparty risk, which is why I go back to Bitcoin, I think could diverge. If we're entering a broader default cycle, which is what would be consistent with the recession, where's the sign to actually allocate into those junkier areas of the market? Because the reality is small cap 30, on a relative basis gotten destroyed. So you want to look for some kind of signal there. Credit spreads, if they do blow out, there's going to be an overreaction. There pretty much always is, in which case you'll get some good high yielding paper. But what becomes sort of the sign for you guys for when to load up more than just breadth? Are there other signals for you that would say, okay, you know what? Now's when you want to get aggressive.
As far as looking into credit, you mean specifically?
Yeah, into credit and just into other things which have just lagged so badly.
Yeah, I mean, so I think you're definitely going to need to see significant moves in spreads before you even consider that. The high yield market is a little bit overweight energy. I think it's about 10, 12% in energy. So that's something to consider as far as, movements and spreads. But, I don't have a specific basis point where we would target to start looking at credit, but that's kind of one of the markets that's diverging a lot, that has a lot of catch up to do on the downside. So that's something that, probably would be more And in spreads, when they move very quick, if we were to see it. So definitely has to be pretty nimble there. As far as, the other sectors like small caps, I really think it just also depends, again, going back to the cycle before you can even think of going there. I mean, it kind of just feels like it's going to be dead money until we see, the cycle play out and the Fed start to ease. And then we'll see the move lower in rates. And eventually those early cycle, plays, whether it's micro caps, small caps, start to actually work. But I think it's not something that you should, unless your time horizon is, 5 years, then sure, you're really low relative levels. If you're underweight small caps, then that's different. But if you're looking more 6 to 12 months, I'm not sure that's something that we would consider yet.
Yeah, no disagreements there. What about the international side? I mean, you look at the VGK Europe ETF gone nowhere for a decade plus, right? Emerging markets gone nowhere for a decade plus. Any thoughts on international investing? It seems like everything's gone the way of Japan except the US from an equity perspective.
Yeah, I mean, so the past decade has been really tough for them, right? Dollars continue to move higher. That's made, international equities really hard to allocate to. And I think even going back to when I was at Morgan Stanley, we had a lot of advisors push back on any type of overweight in any international because it just continues to underperform. The problem with emerging markets, obviously, if you're not in an equal weight index, it's 30% to China. So you have to really just think of, do you want to be in China? And that's going to be a lot of what you have to think about there. But internationally, I think, Europe and Japan, those are a little bit different. But one recommendation that we actually had recently was Turkish stocks. So a little bit esoteric, but the policy pivot that they've had there to fight inflation has been pretty good for sentiment. And there's been historical lows in valuations from a PE perspective. So a lot of that sentiment was already priced in. We've seen foreign investment there actually really boost, similar to what it had post-COVID. And so that means that, the recent move actually has some legs. If you look at the TUR, which is the ETF, the technicals are also really strong there. It's broken out versus the S&P. And it actually has a negative correlation with S&P. So while we have this 2 months of kind of, bad returns for US stocks, Turkish stocks has actually been moving higher. You're getting that benefit of the negative correlation from a diversification standpoint. So that was one of the things that we've talked about recently.
By the way, I want you to expand on that point because you and I both know this being in the business, but this point that you mentioned that, you get pushback from advisors at Morgan Stanley as far as diversifying with international. So what do? They go into basically large caps because their clients, right, are using that as the reference point for the market and the benchmark for most of their asset allocation statements, right? Are we at a point where it's true, it's just everybody's on the same side of the market cap weighted passive boat that it presents like a real risk? I think this is where people underappreciate just how pervasive the concentration in the S&P 500 really is.
Yeah, I mean, it's a tough conversation to have with a client, right? Because, if you look in the early 2000s or, 2000s, you saw the international was outperforming. So a lot of these things go in cycles where you want to sometimes just have an exposure that you keep that you're happy with, but you don't want to, overtrade it or, do too many tactical shifts over time. If you're looking, I'm talking portfolio positioning from like a secular standpoint, looking farther out here, managing wealth money, not from more tactical, but those are conversations where, they were like, why would we invest in that if it's been losing money and we can just put it in SPY? But you have to really just have that conversation that a lot of times, cycles change and over time, that diversification benefit is probably more beneficial for you than just trying to chase the returns that have happened the past decade.
Yeah, I would go back to it's hard to beat the S&P when the S&P is the only game in town. I mean, it's like, why is it that active managers largely have had such a hard time? Because they've been whipsawed to death trying to tilt outside of mega caps.
Yeah, and it's also, do you think we're in a new regime going forward? I mean, do we think higher for longer is here to stay after we have a recession and rates are on average or not averaging 2% on 10-year, but we're 4 to 5 or 6? That is not as great for technology and the growth stocks when you have inflation and rates at a higher level on average than, if you look in the 2010s when all we had was low productivity, low growth, low inflation. And so the incremental dollar went into tech. So that's not something that I think is going to be, sustained going forward.
Get a little bit of the audience up here. If you're there, just click the bottom left to unmute.
Yeah, Michael, I can take that one first. I guess so. I think if you kind of think of the other way, a lot of the movement in the market has been because of where yields are going. So there's been a negative correlation, and especially on S&P when you have a significant part of the index in growth stocks, 60 or 70%. So they're much more susceptible to a higher discount rate. And so you're seeing yields move higher, which the market is reacting to that. So that's part of the reason. But, there will be a point that we talked about previously where, and I think this is going to come more when labor market deteriorates further, that you're going to see bonds actually help you as a hedge and equities still go down, but we're not there yet.
When you have a VIX spike in equities, option adjusted credit spreads, OAS spreads, they widen. So there's a link between the VIX rising, volatility rising on the equity side, and default risk premiums increasing internally in the bond market in terms of, let's say, junk versus AAA of the same duration. Okay, so part of the reason why treasuries have encountered is because you haven't had spreads widen. You don't have that flight to safety sequence. The flight to safety sequence happens because as spreads widen, money says, you know what? I don't want this default risk. This highly levered issuer may not be able to pay off their loan. So let me go up the capital structure quality scale to AAA, ultimately to treasuries as, in quotes, the pristine asset. Now, I floated this idea a few times. I said last week, I said, welcome to the credit event, because treasuries look like they're the credit event at this point. So my own thesis has been, you have this dual breakdown again in a very sharp way from a starting point of yield, which is already much more elevated than last year. At some point that resolves itself, equities keep going down, and this time treasuries counter. Now, I could be totally off on that, but I don't think it's that far-fetched to think of a situation where you could still have long duration yields rising, by end of next year. But in between now and then, you could get some of these flight to safety pulses where it looks like the convexity of the VIX by just being in treasuries.
Yeah. And I wanted to add, just as where you kind of think of a portfolio perspective where tail risk hedging is something that comes into play that people should think about, especially when you have really low implied volatility levels. The only thing that's been working on this downside is being long volatility. So that's something that people should definitely consider.
What are things that you think are under the radar? I'm going to try and go through some of these other guests that want to come up here for a few minutes, but riff on things that you think we haven't talked about that should get more play either in the media or that maybe are kind of sleeper things to focus on.
Okay, yeah. So I think, I don't know if this is not as much in the media it has been recently, but uranium is an interesting one. We're starting to get almost a melt up there, but we've done some work on it, and it's tough to. So these type of bull markets, it's very tough to when it's hard to get in. That usually means it's something that, it's, either in a melt up or in a new bull market, but there's been significant demand there from U.S. utilities. And if you actually look at, the prices of uranium miners, they're actually a little bit undervalued relative to spot uranium right now. And you look at, Camco, which is one of the big uranium plays, on a price to book level, it's still way below where it was in 2007. So, if there's a melt up play, there's room for upside. I think it's tough for us to recommend buying it here. We'll see a little bit of a correction before we get in, but that's something that I think a lot of people may be starting to think about now.
And how do you think about sizing for things like uranium? So I'm actually very much on board with the longer term pieces for uranium, right? But your point, right? If it's had a big move and you're trying to trade around it, depending on time frame, it becomes challenging. It can be quite volatile. So, I always go back to what you own often matters a lot less than how much you own of it. Mm-hmm. So how do you think about weighting, against things like uranium?
Yeah, so there's a number of ways to do it. Again, you can go back to an option strategy where if you want to have a little bit, less capital to it, but you can, kind of price the risk of something that can go up, a lot, double. And so you can buy that without money calls. For something like this, that's obviously a lot more volatile. I don't think anything above 5% would be something that, would be recommended. So, that's something that definitely have to keep in mind. But, a lot of these volatile plays, it's tough for positioning to recommend a significant part of your portfolio.
Yeah. And that's always the real hard part with this game. And it's also why you have to be careful about what, people beating their chests around, how well they've done, because you always see these people on FinTwit talking about some stock that they, in quote, cold right, but they might have like a 0.5% position in it. Like that's not interesting to me. Doug, for those who want to track more of your work and follow more of the stuff that you guys put out with Game of Trades, where would you point them to?
Yeah, so our website is gameoftrades.net. And of course, you can follow me on Twitter and our Game of Trades account below. But yeah, that's our website to check it out.
Everybody, please give a follow to Doug, to the Game of Trades handle as well. Hopefully, I'll do this a few times with Doug in the future. I'm doing another space talking about AI, which is a fun topic for me. I may or may not say NVIDIA's fucked on that space, but I appreciate everybody that's joined. Please support everybody that's here, that's a speaker, and hopefully I will see you all later. Thank you, Doug. Appreciate it.
Thanks a lot.